Something big just happened in Washington, and most people don't even realize it. In July alone, the U.S. government ran a jaw-dropping deficit of $291 billion, nearly $300 billion in just 1 month. Now, here's the shocking part. Revenues actually went up thanks to tariffs, but spending and interest costs exploded even faster. It's like getting a raise, but your rent and debt payments double overnight. The numbers aren't just big, they're alarming. And what they mean for your wallet, for prices, and for the entire economy could shape the months ahead. So let's dive into what these numbers really mean. A $291 billion deficit in a single month is not normal, even by Washington standards. It's the third largest July deficit ever recorded, and it's especially concerning because it came at a time when tariff revenues were hitting new highs. That should have been a boost for the Treasury, but instead, the gap between income and spending widened dramatically. And this is where the lesson lies. More money coming in doesn't matter if even more money is going out. Think of it like your own household budget. If you start earning an extra $1,000 a month, that feels great. But if your mortgage, car payments, medical bills, and credit card debt all climb by $2,000, you're still falling behind. That's the U.S. government's situation. Tariffs did add to revenues, but the explosion in outlays, especially interest on debt, completely overshadowed those gains. Now, why did this happen in July specifically? Government budgets don't run in straight lines. Some months bring in more tax receipts due to payment schedules, while other months see heavier spending as obligations come due. July is one of those months where spending spikes. But this wasn't just about timing quirks. It was about long-term trends catching up all at once. Mandatory spending programs are growing, interest payments are swelling, and economic growth is not fast enough to generate the kind of revenue needed to keep up. Let's put some numbers behind this. Revenues rose modestly, about 2% year over year. Customs duties, tariffs, jumped significantly, adding more than $20 billion to the Treasury compared to the prior July. That sounds like progress. And politically, tariffs are often sold as a win-win. Protect American industries while filling government coffers. But at the same time, spending surged by more than 10%. Education spending jumped by over $20 billion. Medicaid outlays climbed by $17 billion, Social Security added another $10 billion, and interest payments alone rose by $11 billion. These aren't optional categories. They're commitments the government cannot easily avoid. And here's the key. Interest is now becoming one of the most powerful drivers of deficits. When the government borrows trillions and interest rates rise, every refinancing, every bond auction, every rollover locks in higher costs. Imagine refinancing your mortgage when rates are twice as high. Suddenly, your monthly payment doubles, even if the house hasn't changed. That's what the U.S. Treasury faces every time debt matures and is replaced with new bonds at today's yields. It doesn't matter that tariffs are bringing in more. The scale of interest costs simply dwarfs them. Some people argue, why not just raise tariffs even more? Wouldn't that increase revenue further? The problem is that tariffs are not unlimited revenue machines. Raise them too high, and imports drop. When imports fall, tariff collections fall too. On top of that, consumers end up paying more, since importers usually pass those costs on through higher prices. That means Americans face more expensive cars, electronics, appliances, even groceries. Higher prices can slow down consumer demand, and weaker demand eventually reduces other tax revenues, like income and sales taxes. So, higher tariffs can actually backfire if pushed too far. Now, let's step back. What does this mean for the average person? First, borrowing costs. The government sets the benchmark through Treasury yields, and those yields affect almost everything: mortgage rates, auto loans, credit card interest, business loans. When deficits are high and markets lose confidence, yields rise, and that means borrowing becomes more expensive for everyone. Second, prices. Tariffs may protect some domestic industries, but they also raise costs on imported goods, and many industries rely on imports for components, machinery, or raw materials. That means higher production costs, which translate into higher prices for consumers. Third, jobs and investment. Businesses don't like uncertainty. When they don't know whether interest rates will fall, whether tariffs will go higher, or whether taxes will rise, they often delay or cancel investment plans. That slows job creation and weakens economic growth. This is why July's deficit is more than just a number. It's a sign of the structural imbalance in the U.S. budget. Revenues are growing, but not fast enough. Spending is growing much faster, especially in mandatory programs and interest costs. And tariffs, while helpful, cannot bridge the gap on their own. The deficit is the gap between what we earn as a nation and what we spend. And right now, that gap is widening. Could raising taxes help? Technically, yes. Higher taxes would mean more revenue. But there are two big problems. First, raising taxes during a period of slower economic growth could further depress demand. When people and businesses are already under financial pressure, higher taxes reduce spending and investment, which slows the economy even more. Second, politically, broad-based tax hikes are extremely difficult to pass. Lawmakers may talk about raising taxes on corporations or the wealthy, but those measures usually take years to implement and often generate less than promised because of loopholes and tax planning strategies. Could spending cuts solve it? Possibly, but the challenge is deciding what to cut. Discretionary spending, things like infrastructure, education grants, and research, is a small slice of the budget. The bulk of spending is mandatory: Social Security, Medicare, Medicaid, defense, and interest payments. Cutting those requires massive political battles and often public pushback. For example, any attempt to cut Social Security triggers voter outrage because millions of retirees rely on it. Defense cuts raise concerns about national security. Healthcare cuts risk destabilizing an already fragile system. And interest payments cannot be cut at all. They're obligations, like your credit card bill. The government can't just decide not to pay. This leaves us with the reality: there is no single easy fix. The only path is a combination: discipline on spending, a broader and more efficient tax base, and a stable trade policy that avoids extremes. Expanding the tax base doesn't mean raising rates on everyone. It means reducing loopholes, improving compliance, and bringing more economic activity into the formal system. Spending reforms should target waste and inefficiency while protecting essential programs. And tariffs, while useful in moderation, should be designed carefully to protect strategic industries without punishing consumers and businesses across the board. Markets watch all of this closely. Every time the Treasury holds an auction, investors look at the numbers. If deficits look out of control, investors demand higher yields to buy U.S. debt. Higher yields mean higher interest costs, and the cycle continues. But if Washington demonstrates fiscal discipline, clear plans, predictable policies, confidence improves, yields stabilize, and financing costs ease. That's the balance the U.S. needs to strike. Let's not forget the human side. When the government borrows at higher rates, households feel it directly. Credit card rates rise. Mortgage payments climb, business loans become more expensive, and that can mean fewer jobs. And when tariffs push up prices, families feel it in the grocery store, at the car dealership, and when buying household goods. Deficits may sound abstract, but they shape the everyday cost of living. Looking at history, the U.S. has run deficits for decades, but the scale is now the real concern. In the past, deficits would narrow during times of growth and widen during recessions. Now we're seeing huge deficits even in periods of relative growth. That means when the next downturn comes, the numbers could get even worse. The July deficit is not an isolated event. It's part of a trend showing structural imbalances that need to be addressed. And here's the bottom line: tariffs did help fill the Treasury in July, but they did not close the deficit. The claim that tariffs alone could balance America's books doesn't hold up. Interest payments are swelling, mandatory spending is rising, and revenues aren't keeping pace. Without a long-term strategy to manage spending, broaden revenues, and stabilize debt costs, deficits will remain a heavy burden on the economy. So let's leave it with this thought: July's deficit of $291 billion is not just a statistic, it's a warning. It tells us that America's financial path is unsustainable without change. Tariffs fill the coffers, but they can't close the gap. Interest is the silent giant, growing month after month. Spending is locked into programs that can't be easily touched. And revenues, while improving, can't keep up. Unless all three areas, spending, revenues, and interest, are managed together, deficits will continue to mount. What happens in Washington doesn't stay in Washington. It affects your loan rates, your grocery bills, your job security, and your financial future. The deficit is not just a problem for politicians. It's a problem for every household, every business, and the economy as a whole. That's why it's so important to understand it, not in technical jargon, but in simple terms that connect to daily life. And that's exactly what we'll keep doing here, breaking down complex financial stories into language that makes sense. Because at the end of the day, it's not the language of numbers that matters, it's the balance of them. Thanks for watching, stay tuned for the next update, and make sure you're ready for what comes next in America's financial story.